Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, February 13th, 2026. I am your host, Scott Slayton, partner and chief market strategist at Capital Creek Partners. So here's your starting lineup. Leadership change, the revenge of the industrial cyclicals, the revenge of the old economy. Number 2, Sune Takaichi of Japan. Enter the Iron Lady of Japan with a mandate. And number 3, 2 crucial pieces of data this week. Non-farm payrolls and consumer price index data tell me we are in a disinflationary boom. So back to the top and the revenge of the old economy. As of Thursday's close, the Dow Jones Industrial Average was up 3% year to date. The NASDAQ 100 was down 3% year to date, and the S&P 500 was perfectly flat on the year, down a couple of basis points. Now think about these stats. Euro Stoxx 50, up 5%. Japan, up 17%. Hong Kong, up 5%. Korea, up a mind-blowing 32%. And Taiwan, up 16%. What is the common thread here? Those markets that I just mentioned, the foreign markets, are cyclical markets. The Dow Jones Industrials is a cyclical market relative to the NASDAQ 100 and the S&P 500. The global economy is strong, and cyclical markets have assumed leadership. On the other hand, technology, software, and artificial intelligence infrastructure builders are underperforming severely. This trend has legs because the US, China, Japan, and Germany are all stimulating. The old economy is roaring, while the new economy is overspending and overinvesting. The bull market in commodities is also indicative and supportive of the old economy and emerging markets. Many investors have never seen this before. It's been many years since cyclicals and value have held the baton of leadership. Donald Trump is an old economy president. What does he talk about? Energy, steel, oil, automobiles. Those are his focuses, and all of his policies are pointing toward helping the old economy. Transportation, chemicals, materials, industrials, and energy. These are the new leaders, and they're being helped by policy. Meanwhile, hyperscalers with declining returns on invested capital are the laggards. Overspending equals underperformance. That's a time-tested law of finance, I believe. Artificial intelligence is not a threat for the old economy. In fact, it's going to help boost productivity, boost margins, and boost earnings. But it is a threat, potentially, for the new economy. Software, look what's happened there. Now, on to Japan. Sune Takaichi. Bloomberg wrote a wonderful deep dive on who this woman is, her character, her background, who she learned from, where she lived, what she's done for the last 30 years. And I learned through this Bloomberg article that Takaichi has modeled herself after Margaret Thatcher and Shinzo Abe, who was her mentor. She is a strong, learned leader with decades of experience. She's an unapologetic nationalist. She's security-focused. She's pro-capitalist. She's pro-USA, and she's unrattled by China's threats. China came after her immediately after she won the election and tried to rattle her and knock her off her perch. That did not work. She did not blink. So expect a more assertive military posture in Japan. expect constitutional revisions to allow them to invest more in their military, and expect a revival of industrial policy. This is going on all around the world, but remember, Japan was one of the original authors of modern industrial policy, and they used it brilliantly in the 70s, 80s, and even the 90s to build their economy, and they built it into the world's second largest economy until China came along. So this decisive snap election win signals to me that the electorate in Japan wants a firm ideological leader, and Takaichi is that person. I think we're going to see a return of the political confidence of Shinzo Abe, but perhaps even more direct and aggressive from Takaichi. We're going to see higher defense spending. We're going to see closer military integration with the United States. And we're going to see faster growth in Japan. We're going to see more fiscal spending. And when you combine that with tighter monetary policy, which we're certainly getting out of the BOJ, you're going to have a stronger yen. I think that's one of the great takeaways here, is that you're going to have a stronger yen. The Japanese yen got as high as the mid-150s earlier this year. I think it's going to go all the way to 140 this year. A huge move for dollar yen and a stronger yen. So a stronger Japanese leader is bullish for the Nikkei, which is already up, as I said, 17% year to date. That's incredible in just 6 or 7 weeks of market action. So to me, the action is in Asia for 2026. There are many bullish trends going on in Asia for equities, for currencies, so head east. Now on to the two biggest pieces of economic data this week, and they were really big pieces. Non-farm payrolls and CPI. Disinflationary boom. So a double-barreled positive shot came this week from these two pieces of data. January data, not delayed, these were January data. Taken together, these data are bullish bonds, and U.S. 10-year Treasury bond yields are about to crack 4%. They're sitting at 4.03 as I speak. And I think these data are also bullish equities. Payrolls added 130,000 jobs. That's very solid. And remember, with zero immigration, to me, that's an incredible number. The 3-month revision is all the way back up to plus 73,000, and the unemployment rate fell from 4.4 to 4.3. But hidden in this was the underemployment rate. People working part-time for economic reasons and people that want to work more. The U6, called the underemployment rate, fell from 8.4 to 8%. It's now down from 8.7% in November to 8%. That's now in a downtrend. So I'll let others worry and whine over the payroll benchmark revisions of minus 862,000. I think that's ancient history. I don't think the markets care about that. I think that's a political number, birth, death, all that. I'm not going to get into that. But average hourly earnings were in line at plus 3.7% year over year. That's just fine with productivity rising 2% year over year and probably accelerating right now with AI gaining more and more steam. The CPI to me was pure Goldilocks. Disinflation continues its slow grind lower. Both headline and core fell from December. Headline was all the way down to 2.4%, and core has caught up to headline and is now up only 2.5%. Real average weekly earnings surprised to the upside at almost 2%, which is positive for consumption. So taken together, these two key pieces of data improve the narrative for the Fed to ease once Chairman Powell steps down. The bond market loved these data, as I said, with 10-year Treasury yields very close to 4%, and cyclical stocks love the data. Disinflationary boom is perfect for cyclical outperformance. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.